this is a unique event for us in that our typical approach is to do investment webinars. And what we've slowly realized in a lot of conversations is that more and more of our investor community want to hear more stories. And Sid has been gracious enough to not only share his story or share his journey with us, quite honestly, and share his story. But then we had the answer or had the question as to whether or not we could do a little bit more with this. And I called Sid on, I guess it was Thursday or something. And I said, Sid, would you be open to just having a chat with us? I said, I think your story is like pretty awesome. And he said, sure. What are you thinking over the next couple of weeks? I said, no, how about Sunday?
Watch evening.
So anyway, so we combined the two. I mean, as you can guess, if you don't know, we're from Philadelphia here. So Corinn and I are Eagles fans, and Sid unfortunately.
I'm a sympathizer. I'm a sympathizer.
Okay, all right, that's good.
Yeah,
right. He's a Patriots fan. So
see now.
I'm sorry. No. City of champions. So anyway, so there's no scripts here today. Really, what the goal here is to bring this to a little bit more of a personal level. Obviously, we called it a fireside chat, and we legitimately have a fire going behind Sid. You know, so I don't know if you can kind of see that. We got the chair in the way. But this is our keeping room. If you're not familiar with what a keeping room is, neither were we about a year ago. And so we moved into this house. Corinn and I live on a 10-acre farm in Westchester. This house was originally built in the late 1700s. So this was an original kitchen. So kind of repurposed it. I don't think the original developers of this property ever envisioned a podcast or webinar going on in the room, but here we are. So anyway, this is like I said, there's no scripts here. We're going to just have a conversation with Sid. We're going to go where the journey takes us today. We're looking maybe about an hour for sure. It's not going to be till 3 o'clock because that's what time kickoff is. So we'll be done by then. So anyway, why don't we get started with like you guys met in kind of you're still in the life, Corinn's previous life in music. So take us a little bit back. We're not going to go back to childhood, but we're going to at least go back to where you met and where our worlds kind of came together, and then go through a little bit of the journey that took you to where you're at today.
Yeah. So Corinn and I, you don't tell a lot of people this, I found out. Your background as a classically trained singer. So now the cat's out of the bag. Everyone knows, secret's out. Yeah. But that was, I met Corinn, I think it was in 2008. I think I remember seeing you at a gig that you were doing with a small opera theater in Philadelphia. But we didn't get a chance to talk much then.
Must have been 2010.
2010. Okay.
Yeah, October 2010.
Right. It was. Okay. So, and then 2011 or 2012, somewhere thereabouts, we sang, I think, at a church thing together. And so that's when I first met Corinn, and none of this Hearthfire stuff, but we didn't, you worked at the Fed. I met Sergio like probably a year later. I think you guys might have been dating at the time.
2012, yeah.
Right? Or I don't. You might have been engaged. It was somewhere thereabouts. You know, I got married in 2013, and then I think y'all got married probably around the same time, right? Yeah. And then we had our daughter, and then a year or two later and then you guys moved like a mile down the road from us, basically in Springfield at first. So like all this Hearthfire stuff is kind of interesting to me because like I know you guys as Sergio and Corinn, like all this buildup of investments and all this, like I just know you guys as my friends, and it's been that from the beginning. I think that as you started to tell me more about investing, I started to get more interested, but really it was just kind of getting to know you all as people, I think, and as, neighbors and fellow parents, and just like any other person would, kind of get to know people from the neighborhood.
Yeah. And I'll never forget so for our journey, if we started with the triplex, and I think we've told this story probably ad nauseum, but it was really, what was interesting about Sid is when we first started talking about it, it was out of a curiosity. And every time we got together, whether it was playing games or whatever.
Yeah.
It was kind of like a Q&A, and then Sid would take it, which is something that we encourage all investors to do, is you got to do your homework. And what I mean is, you take an idea, you take a concept, and then research it yourself. And so we would talk about something, Sid take it, go and research and say, okay, and then come back with a dozen more questions.
Yeah, I'll tell you a story. 20, I think it was like about 2016, I think. You'd probably know better than I would. You were trying to syndicate, I think it was a triplex on Dickinson Street down in South Philly, right? Somewhere around 15, 16. Stella was maybe like a year old. I think it was like her birthday party, right? And so I remember you handed me, it was like a one sheet you had printed on probably your home printer. You know, you had it in a little binder and everything, and you showed it to me. And we were trying to do a renovation. You know, we like redid the second story of our house. And so, you know, with the idea of where we were at the time, we had bought our house. You know, we signed a normal 30-year mortgage at the time, right? We knew we had to do a renovation. My wife's dad, he's our architect, so he helped us figure out how to do it and all that. But I remember thinking at the time, because I'd started to learn a little bit about being more financially responsible. You know, back then I was listening to Dave Ramsey, you know, because I think that's a good entry point for people if they just have no basis, right? Just to get into like a savings way of thinking maybe, or accumulation way of thinking. I was reading up a lot about like financial independence at the time. And so then you put this thing in front of me and I was like, oh, but you know what? We have all this money that we're saving towards our home rental, you know? And so I was like, I can't do it, you know? And I remember thinking about it after the fact too. Like, I was like, man, I wish I could have figured out a way to like put something together to have maybe invested, you know, on top of doing the reno, but I didn't know about leverage. I didn't know about, you know, oh, pull equity or any of this, or, you know, you can make if you wanted to withdraw from your 401k or take a loan for your 401k or take a, you know, take the capital out of your Roth IRA. I didn't know any of this stuff. Right. So I was just like, oh, opportunity passed. Okay, well, we'll just save, you know, at 4% interest in the savings rate in our savings account, you know, and that'll be the way. And I just have to pass on the opportunity, you know. But sometimes I think back about that because I was like, oh, if I knew what I knew, you know, then I would have been able to say, oh, we can get creative and think about it. But it's just not what you normally know.
Right. So you, and then eventually, what was the year that you partnered up? And talk about your first investment. Was that the property in Prospect Park, or was it with us?
Yeah, no, it was Prospect Park. Yeah, because it was February of 19. I came to you, I think it was like in August of 18, I think, because by then that was now like 3 years removed, right? So that I had passed on the Dickinson project, and then, you know, we had done the renovation, and then our house had appreciated a little bit in value because of the renovation. And I was starting to learn more about like, oh, I've been listening to Bigger Pockets podcasts and stuff like that. And so I was starting to kind of put these concepts together, at least like theoretically, you know, but it was all theory. And I didn't really know people that did like real estate investing. None in my family, like, you know, like you, right? My family immigrated here. I was born in this country, but like, I feel like in that mode, you're not really thinking about all these different tools and, you know, different strategies and so on, right? And so in 18, I came to you and I said, okay, I've been reading about real estate investing for about a couple of years now, and I think I understand how it works, and I think I understand the mechanics of it. And you were working as a realtor at the time at Keller Williams, and you know, Hearthfire. I wonder if it had become full time.
Yes.
Right. So I knew you guys were in now, right? The Fed was no longer a thing. You were in on Hearthfire. So I was like, Serge, I want you to help me acquire property, which is kind of the thrust of, you know, what you were doing. And what I remember of that, so you know, my father-in-law wanted to come in on it too. So the three of us, you know, we were going to start an LLC. My wife and I and Carrie, we started the LLC. And so like September comes around and I'm like, okay, like in a month we'll have acquired a property, right? I figured we'll go look at some properties and you'll help us buy one. We closed, I think, in February. And I remember like every few weeks coming to you, be like once a week, I'd be like, I found this property. And you'd be like, don't. I'd be like, okay, I found this, don't. And we did this through the whole fall. I kept sliding properties in front of you, right? And there was one we almost went on, I remember, in Glen Olden. It was a duplex, I believe. And
Oh, I remember that.
yeah, it was bank owned.
Yeah,
right?
yeah, I remember that.
And we
property.
almost went in on it, but there were a lot of conditions around, financing when purchasing through a bank without, not buying in cash and so forth. And they had all kinds of requirements for that you had to,
Right.
indicate, especially if you were an LLC making the acquisition. And we knew we wanted to invest as an LLC with all the different people that were coming in. So we passed on it. But at that point, I was like, this dude just doesn't like properties. Because I'm like, I've been through like 15 of these. And I'm like, what's the story here? When do you go to a realtor and the realtor keeps putting the hand up? Like that never happens.
Right, right.
Usually if you're talking to a realtor, they'll like just, walk you right through the front door and sign papers because they want the commission. And here you were basically like actively refusing to close the deal. And I'm like, who is this guy? Right. And so then finally that, the property in Prospect Park comes along, and I can't remember. I think we had looked at, there was a place across the street, the bakery. And we had looked at the bakery across the street,
right,
and we
right.
decided not to take that either. Same game, same thing as before. But then you had discovered the second one. He said, well, wait, did you look at this one? And at this one, I was like, fine, whatever, man. You pick what you want, because I don't know what we're looking for. I mean, I could see your reasoning, to be fair. Like every time you had a very articulate set of reasons. Look, there's this issue, there's this issue, there's this risk and this risk. And in my mind at the time, as a new investor, you seemed so much more conservative than I was. But again, I just only knew what I knew, right? On paper, I was like, it looks right. There's a cash on cash return. Here's the cap rate. Why are there more questions? Like I had no internal understanding of the property. So then we finally went in on this investment, and I think we closed in February of 19. And that's where, like, when I started to like kind of talk with you about the property and how you were looking at some of the mechanics that aren't on paper. We had like a 40-year tenant, I think, in kind of like that was commanding a substantial portion of the rent. We had, other long-term tenants in the commercial units, reliable residential units that were near public transportation, a popular area to live in. So I was like, oh, that's the kind of stuff that you don't see on your MLS listing.
Right.
Whereas I'm all about numbers and so on. So the numbers always looked right to me, but all this immaterial stuff, never came to mind. And so it's turned out to be a really solid investment. Yeah. And that's, I think, what started to build that relationship of like, okay, Serge is working on a different level from like what I'm working on, because I'm only looking at like, numbers and percentages.
Well, because we've been hands-on managing our own rentals since 2012. So a lot of, I think beyond the spreadsheets, a lot of maybe what Serge was using to say no to was our own hands-on experience of managing different types of rentals in and around Philly.
Right. Yeah, and I think the way that and really what it comes down to is two factors, maybe it's three factors that we look at when evaluating a deal. One is the spreadsheet part of it, right? That's the analysis and what are the current rents, what are the current expenses, what might they be when we take it over, where is the potential there. The second element is what is the story, right? What is the story? Why is the seller selling? Why is the what's the story with the tenants? And then the third is, what is the business plan? What is the plan? What do we do? Where is the value being created with that? And I think with a lot of the properties that we looked at, and in some cases just fundamentals where you go in and you say, okay, structurally there's this issue, there's that issue, right? And when we're looking at value creation, it's always about making sure that the risk profile and the ability to execute a business plan are really anchored in where there's going to be yield. Meaning that if you've got a property that is got termite damage and you've got structural integrity issues, fixing that doesn't add value to the property, right? Because you're just stabilizing it. So it's kind of like, okay, you can get rents at one level, but if you've got structural integrity issues, you're just trying to get it fundamentally back to stabilization. Versus if I've got an old and dated apartment and I renovate this apartment, then I can add more revenue that way. So I think a lot of the case, that was it. And in this case, that the profile of the property was 3 commercial tenants,
mhm,
right?
mhm.
And two apartments.
Yep.
Right, and one of the apartments at the time was rented out to, I guess, American Airlines or something like that.
Yeah, pilots, yeah,
Pilots,
right.
They were coming in and out. It was kind of what they call their crash pad or whatever.
Yeah,
And we
yeah.
looked at this and we said, okay, there's a lot of value to be created here. Talk about like so you made the decision that you guys are going to do this.
Mhm.
Did you take out, like, you renovated your house and then you
Yep.
took out equity and that
Yeah,
kind
we
of
took
went
a-
towards that?
So what we ended up doing, we first after the renovation, right? Because again, not coming from like massive generational wealth, blah, blah. I don't have any estates to work from or anything. This is all, earned income that me and my wife, scraped together and needed to use to try to create some kind of stable lifestyle or just to create stability in our, because as musicians especially, you don't have any kind of stability. So we're just trying to create these kind of,
Right.
little contingencies around us. So then we took out a home equity line of credit. And I think we might have used part of it for the reno, if I remember correctly, but then we basically took the rest of it and said, okay, this is going to become our down payment towards the property. My father-in-law, he's much older, so he had the assets, of course, to be able to, make his contribution. So he had no worries about the cash or anything like that. But for us, it was like, okay, so we're going to take that home equity line of credit, tap it, go into this investment property, consolidate the two loans at a fixed rate, and that'll become our new mortgage. And so now we would have never thought of doing anything like this
Right.
in like whenever I first bought the house, because I don't think no one thinks of their house in those terms.
Right.
You just think 30-year mortgage, sign your life away, call it a day, and again, scrape together your pennies and hope to make a retirement out of it. So we did this strategy and we made the down payment. To your point though about, risks, I think one thing you did that was that I value very much in hindsight was there's always risk, right, with a property. It's just a matter of what they are and whether they're manageable. Right. So in our case, like, the foundation wasn't crumbling or anything like that, but we did have a very substantial long-term tenant. And I think that they had a lot of items of deferred maintenance that had accumulated under previous ownership. So you had to negotiate a new lease with them.
Right.
And that became a very critical piece because they were, at least fronting with the idea that they might not return. And that would have put us in a huge position, right? Because we had to do that, I think, within the first year or maybe year and a half of ownership, right? And I remember you negotiate, and I don't know how to negotiate a lease with a commercial tenant. I've never even signed a commercial lease. So what do I know?
Yeah.
Right. So there too, it was we scraped together our pennies, right? We don't know we know theoretically what we're doing, but we have no real world understanding of any of this, right? So that's where I felt that was a very valuable, what's the word? Contribution, let's say, towards our continued ownership of the building was being able to sign them to a 5-year lease. We did agree to put a number of improvements in. Not only do we agree to do it, though, we also worked, I mean, Corinn, because you were managing the property for us, how we're going to fund the renovations, right? We weren't just going to like throw a bunch more money down the drain. We were going to kind of cash flow it and schedule them out, right? Because we didn't have tens of thousands of dollars to do all this stuff. So we had to figure out a way to use the revenue from the property to be able to fund some of these continued improvements. But now, the last time I talked to them like a year ago or so, because we had done all this work for them and they didn't know us at the time. But when I talked to them again about re-signing, they're like, yeah, we're probably interested in staying because now we have, a working relationship. They've seen us work for 5 years. So we don't have this like mistrust or skepticism about what we are as owners.
Yeah. One of the things that, is worth highlighting is I think our relationship, and this is certainly who we are, it's the attention to detail.
Absolutely.
And the details matter. And so like when we are evaluating any of our deals, and this goes way back, it really comes down to, even if like one piece may seem huge, but then there might be a lot of pieces that add up.
Right.
Significant, right? That lease, that single lease was a huge part of it. And we knew that right away.
It could have tanked the property if it went wrong.
Right.
And so we would have been operating at a huge loss if we hadn't re-signed it.
Exactly. And so you take like the deal that and now our development deals, right? So Whitehall deal that we're in the middle of raising money for right now. and land development in general, when we're tying up a property and getting a piece of land under contract, we always include in our contracts that we're not going to close until we at least get approved to build what we want to build.
Right.
And we become fully refundable. So that puts the onus on the seller to make sure that we're buying a piece of land that we can do what we want to do. Now, that's relatively common in land development these days, but and many times people just buy things saying, oh, I think I can do this. And then next thing you know, you really can't, and you're in trouble.
Right.
What I want to talk to you about is, the way that you did that is, it can't be understated that you looked at your existing assets, obviously your house, and you did the addition.
Yeah.
But you kind of you took a three-dimensional view of that equity. What I mean by that is most people do that and just say, okay, my house is my house. I'm going to look at other ways to invest. But you looked at the equity that you forced into it with your improvements.
Yep.
And then the equity that appreciated, and then you decided to redeploy that.
Yep.
In my world, I say every dollar has a job is one of the lines that we say. It's really just, how do you put that money to work? Walk through a couple things. Is one, what exposed that to you? And then how did you get your household on board with that, specifically Val, right? Because
sure.
You're the finance guy, right?
I think that it helped that, her dad was also interested. So like, even in all of these, I think, conversations, whether it's with you, with Corinn, with my father-in-law, Kerry, with Val, right? They're people. They're not like robots that process numbers. You know what I mean? So like, you can't just math your way out of this, right? You got to know the players involved and what their concerns are and what they want and what they don't want and where their stresses lie and where their anxieties lie. So like Val, for example, is a much more risk averse general like saver or investor than am I. So if I come to her and say, hey, I'm thinking of diversifying away from the stock market, for example, she'll be like, sure, that sounds awesome. I don't like the stock market either. You know what I mean? Yeah. So like, in that way, like you if I were to come to her and say like, hey, I want to start flipping houses, she'd probably lose her mind, because she's like, what do you think? Where you don't know the first thing about construction, So like, I think you have to be able to kind of know, and Kerry along those lines too, right? He knows commercial properties, and I think was interested in having some, landlord exposure, let's say. And so that's how you come to him too and say, hey, do you want to come in and partner on this deal and, be direct owners of a building as opposed to some limited partner, so on and so forth. So I think there's different strokes for different people too. Someone might say like, no, I don't want to be a landlord. I don't want to have active ownership. I just want to be a silent partner, which by the way, he is, right? He's invested in some of the syndications also.
Yeah.
And so that's where I think it's just about, kind of being able to hear out where everyone is.
I think what's really unique and interesting there, and we did the same thing, is we often, and this goes back to what I was talking about, the three-dimensional part of it, is a lot of new investors, and I don't know if any of you on the call are new investors, but think about it as this is something I have to do and I have to save in order to do it, versus in your case, you established that family partnership, right? And you're having that conversation around the table, or literally and figuratively. And we did the same thing with Corinn's parents. Initially, was just talking about, this is what we're doing. So you aggregate the resources around you, and it's kind of like, and we've got a few investors that family members individually,
multi-generational, we've got fathers and sons,
right? Sure.
And kind of come together, and it's interesting because it allows you to think about leverage, right? Leveraging your resources. And the name of the game in real estate is leverage. It's the only type of investment, unless borrowing on margin or investing on margin.
Well, I think it's important also to differentiate leverage and risk, right? Leverage doesn't necessarily mean risk.
Right. You're right.
you know, so you can lever into risky concepts, absolutely, and that I mean I think is foolish, frankly. But leverage is just a means of saying, okay, what resources do I have?
That's right.
You know, and how am I going to pull those resources to do whatever thing I want to do?
That's right. That's right. And some of the things, correct me if I'm wrong, did you use a self-directed in any investment?
No, I've always kept because for me, I feel like that's too risky.
Right.
You know what I mean? That's just my own threshold. I say,
Yeah.
no, I don't want to get into custodians and all this and blah. I'm sure other folks do it. I've read
Yeah.
about it, you know, but my Roth IRA is in equities, right? Val has a SEP IRA, that's in equities too. I've got a 401k. I keep that. I don't pull loans off of it. I know I could, you know, and maybe I will someday.
Yeah, we've I mean, we've had always had the mentality of when you think about risk, I think about what most people operate is in a scarcity mindset and refuse to take the risks that can propel your life to something new and different.
You know what I think is important there? When thinking about buying a property, you want to actually know, okay, what does the real worst case scenario actually look like? What does failure actually look like?
Right.
Don't just call it failure and it's terrible, right?
Yeah.
What is the actual worst case scenario? What happens to you? So like if I don't know, a storm knocks over this building or one of your storage facilities, say, right? What happens to me as an individual?
Right.
Does like the Grim Reaper show up? No, right? Like all that happens is maybe I lose what thousands of dollars I put, but that's not going to happen because it's insured.
Right.
You know,
Right.
It's probably a pain in the neck, right? And other than that, my life goes on.
Right. Yeah. And and so that's an interesting point is there's, I think a lot of people are more afraid. It's the fear of the fear.
Yes.
Not the actual, like, because if you break it down, I said the number one riskiest thing that we do,
right?
That statistically, I mean, obviously there's two worst things in life: losing all your money and dying.
Yep.
Right. The dying part, the riskiest things you can do is get behind the wheel of a car.
Yep.
Right. Because statistically, you're more likely to die in an accident because you're driving down the highway with cars coming towards you than you are for anything that we do.
Right.
And to your point, when it comes to investing, okay, you put $50,000. We always make sure that it's not your only $50,000.
Yes.
Right. And you're not moving into an RV or somebody's basement to do that, because technically you wouldn't qualify.
Right.
But it really comes down to that is the limitation of what you can lose. But what happens is, and this can't be understated, is once you take that step, and we've seen it over and over again, transform lives of signing the paper that now you're an investor.
Mm-hmm.
You're not just like read a bunch of books and all that. Once you're an investor, the game changes.
Off the sidelines and you're in the
game. You're in the game,
it.
regardless of what happens to the actual investment. You've done that. Now, if you're the type of individual that says, okay, something goes sideways, I'll never do that again, but chances are you're going to live in your own little bubble beyond that. But if you recognize that the first step, and then you say, oh my, this isn't so bad. Matter of fact, this is intriguing. The first investment I ever made was around was the .com bubble. I was young. I was in my 20s. I took out $5,000. I put $5,000. Now, granted, I was living at home, so I could do this. I put $5,000. I opened up an E-Trade account. I still have the E-Trade account, and I started buying, .com stocks.
Right.
We all know what happened. So I lost $5,000. However, I don't consider that anything that I've ever lost in investing. I just consider it an expensive education, right? Because you learn, and it's invaluable. It's one thing to talk about theory and concepts and what happens. It's another thing to experience it.
Yep.
So when I experienced companies going bankrupt and said, okay, what's happened? You're forced to learn. It's not just reading the news or whatever. And what we've seen with individuals that have gotten investing, and what was your first syndication that you invested in?
Bird in Hand is your first one.
Oh, Bird in Hand, the first self-storage.
Talk about risk. You guys, I remember you went out there like 3 days a week from Springfield out to, what was it, Lancaster or Limerick or wherever that was. And you would stay in an RV, because, okay, for the folks out there who don't know, right, this was a two-man operation. It was Corinn and Sergio syndicating investments. They didn't have this big old fancy team with all the other construction people and all this whatnot, right? It was the two of you guys running the syndication, and your front office person bailed on you or something, right? And so then you had to get out there and run the place yourself for a while, right? And I remember talking to y'all about it because you still lived in Springfield at the time, and I'd see you guys and we watched football together. And I was like, y'all are nuts. What you're trying to do right now? You're living out of an RV. Your daughter's like
people. We had a 2-year-old daughter.
Yeah, right. You had the daughter too, and I'm like, what are people doing?
Yeah.
Like, what crazy? Talk about risk. Like, I'm just sitting over here as a silent investor, just being like, hey, y'all do what you're gonna do to keep this thing afloat.
Yeah, we laugh about it a lot because our journey has always been about. Kind of, it really depends on how you define risk. Because for us, there's risk and opportunity.
Sure.
And it really there's a fine line. And for us, when we bought the first property, and that was the triplex, and the biggest risk that we had was probably trying to find contractors, and you sign a contract, the risk is whether they show up or not, right? And that's a big part of it. But every step of the way was us recognizing that, oh, what else can we do? What else can we do? And every property that we bought in the multifamily days, it wasn't just a math equation. And quite honestly, the brokers and realtors that we worked with, they were projecting different rents, but we knew that we can get higher rents because we were willing to grind and do whatever. The first triplex that we bought that was the rehab was 320 Dickinson, right? And the way that we controlled the risk, this was a full gut rehab. We had it under contract. We were going to close when we were going to lease it, or we were going to close on the property when it was done, but we had it under contract while it was still being built. And I know you remember this. What we did was we talked to the guy selling, and we said, can we start trying to rent these units out before it's done? And the agent was like, I don't know how that's going to work, but sure.
Okay.
And so what we did was
walking people through it as a construction zone, showing them floor plans.
Right.
And so we did this, and I think we closed in like April and May. So we drummed up the attention on it, and we literally were walking people through studded walls from one room to the other, showing the plans. This was 2 months before we were closing. We had the entire building leased up that day. People went out of that building, went to their cars and filled out the application because we sold them on the vision. Yeah. Right. And it was great. I mean, that was a fantastic property.
Great neighborhood.
It was, yeah. So that was one of those things where the rents were like $1,200-$1,300 a unit. So from the day that we closed, actually even before that, we had it leased up. We were collecting rent immediately. So when I looked at it, I'm just like, I don't see where the risk is with this. And we were doing fine. When it came to bird in hand, when we first went out there, and yes, we didn't know anything about self-storage, not even close. And yeah, we read some books or whatever. Sure. But what we looked at, where's the value going to be created? And this particular property, they were running it paper and pen. I'm a data guy. And I said, okay, when you're paper and pen, you've got no data. You have no idea what you're doing. So we went out there and we met the guy, and from the time we took it over, he was apologizing. Sorry, this is all like this. I said, don't apologize. This is why we're buying it. It's like, I'm not buying real estate. I'm buying an IT project. And so we were able to get in there, and that was the big part of the business plan. And then everything else was like kind of ancillary. And then we had to navigate COVID and everything.
I'll tell you, with bird in hand, and I feel like also with our building, in the first year or so, and I think this might happen to other new investors too, you read about things like, let's say, cash on cash return or cap rate, right? And you have an academic understanding of what that concept is. And so then in your first few years, I talked about that deferred maintenance, say on Prospect Park, in our Prospect Park building. And also, let's say in the case of bird in hand, right? I don't feel like the distributions we collected in those first I think we were only in bird in hand for a couple of years. But those first few years, every dollar that we were earning on our investment property went back into the building. And so I'm looking at that. I'm like, well, this isn't cash on cash return.
right.
Everything's going back into the building. Where's my cash on cash return, guys? And I'm like, what are you people talking about telling me it's cash on cash return? I know what that means, and the numbers don't calculate, right? But then, if we're talking about the investment property at least, we recalculated after all the rent started to increase and so forth. We said, okay, what's an 8% cap return, after 3 or 4 years of owning the building with these appreciated rents? And that's what's like, oh,
Yeah.
all of a sudden, like all the chess pieces on the board showed up, you know what I mean? Because I went, wait a second. Oh, okay, doesn't have to be month over month income to necessarily make it a lucrative endeavor. And similarly, bird in hand, those distributions weren't anything to write home about necessarily, but I think it was a 2.5 or 2.3 some odd return after like 3 years, I think, right? Because the thing appreciated tremendously in that climate. And so, you didn't think anything of it at the time when you have your investment and you get your little quarterly distributions and you get your newsletters. And I'll be honest with you, like, I read them, but like, I don't know anything about self-storage, right? I don't know for all the metrics that you're throwing at me and so forth. Like, I can't necessarily, I understand numbers, but like, I can't tell good from bad because I'm no seasoned investor in this space.
Yeah.
But I did come to figure out that I'm like, hey, these guys kind of know what they're doing.
Yeah.
Right. And so I can run with that because they're way deep on this. Right. And I can just kind of ride that with them for a while.
Yeah. So now, all right. So, and by the way, everybody, use the chat if you got any questions along the way. We're just kind of chit chatting here. If anything kind of piqued your interest, you want to go in any different direction, let us know. Feel free to use that.
But I mean, thanks for saying that, because still so bird in hand was the first one. Some of our next couple acquisitions that are heavy value add, where we're still doing operational improvements. We do get those questions regularly from the investors of like, why are distributions so low? Because when we first underwrote the deal, it was supposed to be XYZ, and just continuing to convey that message of patience of like, really the investment return is going to be on the exit or later in the business plan, especially for some of those where we're still, it takes time to be implementing all of those, whether it's existing customer increases or what have you. So that's just a message we just keep conveying to investors. It's not that the properties are underperforming. It's not that we're not executing on the plan. Just these things do take time. They're going to take a year or two.
There's a couple ways. So I always look at it, and I talk to new investors this way. It's where are you at in life, and what are you focused on, and what are your goals for your financial future? And I'm 49, and where we are at in life is growing our equity and growing our principal in multiples, right? Compound growth, not linear. What does that mean? That means that I'm not looking to gain an extra $100 in my pay or per month. I'm looking to double my value, my net worth every so many years.
Sure.
And so through the journey of my prime years, I'm focused on, one is expending my labor into things that I'm really passionate about, what I'm really good at. And then my investment focus is on growing my principal as high as I can. And then when I decide that I want to take a step back or be a little bit, either whether it's be passive or turn on the faucet of living off of distributions in cash, then it's a different focus.
Absolutely.
Right?
Absolutely. Yeah.
And so for us, and this is who we are as a company right now, is we are very much accumulating and growing principal. That's the name of the game here. So yes, the distributions are going to be lower, but the sausage that's being made is for the big exits, right? That's what it is. And we're doing it on an individual asset basis, and we're doing roll up. As you're doing, you've got your Prospect Park property. You've got, how many syndications are you in?
I think 3 at this point. If I'm
3.
Yeah.
So you're investing, but you're not looking at it like every 5 minutes, like a crypto.
No,
investment, right?
absolutely not. There's no value to it. And to be fair, like I don't remember what projections you put on Bird in Hand or the income fund or the growth fund or whichever ones it is, like, oh, you made a 2.4 multiple instead of 2.3 or what, like, who cares? You know what I mean? It's just diversification, and it's working with trusted partners. Like, that carries so much more value than, you know, 19 versus 18% return or whatever, you know, little incremental gains we're talking about. Same thing happens if we're talking about equities, right? As long as you have an investment strategy and you're taking that strategy, you know, if someone does a little bit better or a little bit worse than you do, the fact is now you're a participant and you start to learn by way of participating in the process. Even if you take a loss, you'll probably learn from that participation as well.
Yeah, yeah. The interesting thing is the most what I would call advanced investors that we have, and these are investors that pretty much invest in most of our deals. They've come to understand the principles that we're talking about, that we are value add, focused on yield and growing of principal.
Okay.
And what they look at is they're diversifying within their portfolio. I mean, across the board. Usually they're not just investing with us, they're investing in different things.
They're never just with us.
Right. And so when they say, okay, my self-storage investment's going to be with Hearthfire, maybe I want some multifamily, maybe I want some retail or whatever.
Yeah.
But they're looking at it, they look at the fundamentals of the why and the where, and they've come to know us well enough to know that we're very picky and selective on what and where we invest. That for every one deal that comes out, we've looked at hundreds, if not thousands of deals.
That's what we talked about earlier, right? You kept saying no to me when I kept handing you real estate properties, right?
And that is where it's the scale of what we're talking about, and how we went from doing 1 or 2 deals a year now to doing 4 or 5 was really about how do we build and scale the team, the platform, the data, so on and so forth. But they're like automatic check writers now. They get the information, they'll read, watch the webinar, whatever, and they're in.
Yep.
Right? And these guys, and I know a lot of them personally, and they're investing in a lot of different things, including some super risky stuff like I'll say technology venture capital type of funds,
right?
Where the or oil and gas or whatever. And the goal and their objective is they know that every tranche of their equity or their investment dollars is dedicated to some portion of risk profile. The venture capital stuff, they're looking at 1 out of every 10 being a home run. And if you're part of that, you know, investing in Uber and you get in at the right time, then you know that you can 10x that money, which will make up for the 3 or 4 or 5 that you were losers on.
You know, I think too that also, I think it's important to distinguish. Usually, I would say in almost every case, investing is boring, right? Boring investing is successful investing, in my opinion. Now, if you want to invest in NVIDIA or what have you, right? I think that's all well and good, but you got to be able to differentiate between entertainment and investing, right? Are you there because you want to be a part of this roller coaster, or are you actually thinking about, like, you know, compounding growth over time? And so investing in self-storage is nothing that exciting, right? These are pretty boring looking buildings by all, you know what I mean? They perform perfectly well. They're very recession resistant. You know, they tend not to swing with the economy and so forth. So by all, they're very vanilla investments in a certain manner of speaking, but they're very performant. And so if you're trying to do all that fun stuff, you got to, I think, keep in mind, right? Are you doing this as a methodical venture capitalist, or are you just there for the ride? You know what I mean? And kind of having it clear in your head.
Yeah, and I think there's a place for all of that. You know, we always talk about the journey. And
go to the casino if you want to do that. You know, go play blackjack or something.
That's right. Yeah, there's a place for that, and even within real estate. So, talk about how you bought the property in Prospect Park.
Yeah.
Right. You've had a certain amount of success. I don't know what that's worth now, but probably it's done very well. And you could probably cash out. What was your philosophy with now doing passive investments as well?
You know, I'll be honest with you. I don't know if I particularly like being a landlord, you know? And so, like, I think that's all it comes down to, you know, is like, I do like I do like being invested. So also I think sometimes I feel there's this impression that it's like, oh, you either have to be in real estate or equities. I'm like, oh, you can be in both. You know what I mean? You can have a methodical strategy in the stock market. You can have a methodical strategy in real estate. You can have a foolish strategy in either. And so I'm invested in a lot of equities. I like investing in equities. I like following people like Warren Buffett and value-based kind of, metrics of how to choose companies that you want to have. I try to think about, things like single stock exposure and how much I want to be. And then also in real estate, we have our investment property, and I've thought about kind of some of the things you and I have talked about. Oh, take out the equity and buy multifamily and blah 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 blah, or sell it and do a 1031 exchange, and like I know those things academically again, but like I don't know. I don't see a reason to get in all that. I guess it's either a question of risk tolerance, or it's like, what, now I want to manage like 15 tenants? That doesn't sound fun.
Right. And even though you have a property manager, you're still active,
Of
right?
course, because you have to be on some level, right? You got to at least watch what the property manager is doing and be in constant communication with them, unless we really have, I think we've gone through three, I'll tell you, actually, that was one of the things that in hindsight, that was an embarrassment of riches when y'all were managing the property, because y'all were punching so above your weight class. I guess for the folks right on the call that don't know, Sergio and Corinn were managing our property when they acquired it. That's what Hearthfire, I think, in its origins, right? You were managing properties, acquiring properties, and sort of assisting investors in a wide variety of ways before it became kind of this like really emphasis on self-storage. And so it was so smooth, I remember back then, that also contributed to my
In his view.
Yeah, for me.
On our end, it was torture.
For me, it was, and so I was like, this is kind of easy. Like I don't have to, right? I don't have to stay too involved. But it did contribute, I'll say, from a long-term perspective, to this idea of like these two particularly, but then by extension, this company that they've created, they really know what they're doing. Again, I don't have to go 2.3 multiple, blah, 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 blah. I don't have to like pour over your statistics, because I'm just like, my wife likes to joke about this with me. She says that I like to have guys. I like to have like a meat guy, a vegetable guy. I like to have a guy that's like an expert in a certain area that I can go for counsel. And so,
that's good.
And here, right, I feel like Hearthfire is like my real estate guys. You all are the people that know this area so well that I don't have to check your work, and pour over your analysis. I can kind of take it, I can look at it, right? I can see what it is. I can look at some of the high level things and then kind of take you at your word, because I've had continued success for, what's it now, 7 years or so, right? Going back to when we acquired the property, or it started talking about acquiring properties even. So I think that I guess it all comes to say that I don't have to look at what you all are doing that carefully.
Yeah.
Well, this is the concept also of who, not how, right? Of like, it can be overwhelming when you're starting to look at investing or real estate or whatever, and you think that it's you individually, independently, who has to do everything. But like, if you have your guy, right, you identify a couple really key resources, then that helps you exponentially grow. That opens up your capabilities. That's what we have been learning as business owners, of like, we have people, in our roster who have built companies before, who have been 10 steps ahead of where we are now. So we're not limiting ourselves to only being able to accomplish what we, in this stage of our life, what we have experienced, what we've been able to learn. We have that, phone a friend kind of a level of resources behind us. And you have to also release some ego there to be able to like call upon people when you're looking for guidance and counsel. But that's the only way to exponentially grow. Otherwise, it's one day at a time.
Yeah, it's all on you otherwise, right?
And that's exhausting. It's not nearly as much fun or engaging as building something with other people and being able to share the wins, the ups and the downs, right? Like we are social beings, and so who we have in our life is massively informative to our experience of life overall, in business, personal.
I was thinking earlier, you asked about why did I decide to move into passive investing. I don't feel like I answered your question. I think it was One, I didn't really particularly like being a landlord, right? It's fine. It works well. It works for some folks. Some people like to be down in the muck and active in their real estate investments and close to what they're investing in. Not so much for me. I'd rather go watch football and do other things at one time. But so that was probably the, from a logistical standpoint, one pivot to say, okay, if I was a silent partner or a limited partner, right, I don't have to be so careful or heavily involved in the investment. I think the other piece of it too is just, I thought about buying a self-storage property for myself. I think I might have approached you about one that was like small in scale, 15 units maybe, or, several hundreds of thousands of dollars that I could have leveraged my way into or something like that. I don't know the first thing about how to manage a self-storage property. I don't know if it's working well or if I have the right rents or blah, or if I have enough capacity or occupancy or what. I don't know any of that. So what am I going to do with this thing, right? At least if we're talking about a multifamily property, like I can figure out whether a tenant's happy or whether there needs to be a roof or something. Like I have some frame of reference here. So if you want to be in a different asset class, it could be industrial, it could be self-storage, it could be, I don't know, any of a number of other things that aren't just traditional residential real estate. I think you've got to find, a partner that's going to kind of walk you through that thing.
Right. We got a question, and this is really it's funny. We're approaching an hour, and said, can you just kind of introduce yourself? Yeah, sorry. Kind of, it was the thought was maybe everybody noticed, but obviously we jumped right into the conversation. So I'm Sergio Altomare.
I'm Corinn Altomare.
I'm Sid Misra.
And so we're founders of Hearthfire Holdings. Sid is now, hopefully by now you realize, that's been part of our journey and friendship for quite some time now. So sorry if that is kind of filling in the blanks now. Hopefully we'll do a better job, and maybe we'll insert that at the beginning. Yeah. But anyway, the point, I think with the point that you're making there with the passive investing, right? There's so many groups out there that throw that around and say, especially in the guru world, that tell you, I'm going to teach you how to buy a property or whatever. In the self-storage world, there's plenty of guys out there that's going to teach you how to buy your self-storage property, your 10,000 square foot, your 50 garages type of situation, that you don't just buy it, implement some software, and everything is going to be unmanned and keyless or whatever. It doesn't work that way. Mm-hmm. You're still going to be very much active. And what we've experienced, even in the multifamily world, that if you've got a day job or anything else, that it's not passive. Even if you got a manager, because you've got to be part of, hey, this happened, you want to do this. The water heater, you want to go with this, you want to go with that. So the idea of it being passive is usually a misnomer. Our experience has been that the independent investor that is not doing it full time goes two directions. We went full time because we just got to that oh shit moment. We've got entirely too many things going on here. We can't maintain a day job and a night job.
Yeah,
and then
you pushed all your chips in.
Right. And we said something's got to give, and we kind of bet on ourselves. But usually people get to about 3 or 4 properties.
Yeah, sure.
Before they break.
Yep.
And when you get to that, you're just like, you're managing, you're accountable to the P&L, right? The property manager is managing a lot of units. Their job is to make sure that the tenant calls, you can handle everything, but they're not that aligned. Their alignment is really going to be on making sure that rent is collected so they can get their management fee, right? The difference when it comes to passive investing and what we do, especially if you're not familiar with, say, the preferred return, what that means is that if that property doesn't perform, we don't get paid. Right. That the preferred return means that profits on that come to the investors first.
Right.
Which is really just, it's the difference between working with a financial planner that says, let's invest $100,000 across these mutual funds, and I'm going to take my commission. How those mutual funds perform is, they don't really, not that they don't care, but that's not what they're incentivized. They're incentivized in you deploying money, versus we're incentivized by the property performing, or else we don't make any money.
So, to the question, I think also, it's probably worth adding. for, since maybe the folks on the call might not know me all that well, I'm not some highfalutin investor, right? Or like with broad real estate experience, or like, oh, family knows real estate, blah, 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 any of that. Like at the time that we invested in our first, in this Prospect Park building, I think our household income was, between me and my wife, I want to say probably $85,000. We were not, I would call it middle class, I think, roughly. And, I mean, even going back to when I was, working as a performer, I was making a very meager income. Like we're talking $20,000 when I was in my 20s. Like, I'm not of a place where it's like, yeah, I have vast years of understanding real estate and investment vehicles and all this stuff, I was interested in learning how to invest, back in 2016 and 17, after our daughter was born, after I wanted to try to create a more secure footing for our family, after experiencing a lot of risks working as a performing artist for so many years, and craving some sense of stability and like continual income that I could see was, a thing that I didn't know as a freelance musician. And but we were not in some position of like, oh, we have lots of, assets to deploy, right? We had to take out a second mortgage to make our first investment. That's how, but it was a logical decision for us. And, I think our assets have grown and our income has grown over time. But, for all this talk of, I think, what you can do as an investor, I think it can sometimes seem intimidating. Right? Like you have to be an investor, right? No, you just have to be a dude that wants to jump in the game.
Right.
With at least the means to access capital and the understanding of what risk, or I should say, what liabilities you're maybe taking on if you decide to invest.
Yeah, and I think what you demonstrated is that we talk to a lot of newer investors that just say, well, I'm saving up. And in many cases, it's kind of like, if I poke into your world, I'm fairly certain I could find the investment dollars, right?
Yeah, sure.
Your equity in your home, right? We have plenty of individuals that had an old retirement account from a job that they had or whatever, and rolled it into a self-directed IRA. We've done that. And so having the, your own partnership within the family, all you have to do, the number one requirement is you have to want something more, right? I think that is you want to change the trajectory of your life, your future. That's it.
Yeah.
Right. And because what are we talking about? We're talking about buildings and properties, and you walk into them day in and day out. You go to any city, every one of those high rises is owned by different people. You can be part of that. Our platform now, we've got over 20 properties where our investors, they own them.
Right.
We own the smallest portion of that, right? The bank has that.
So I'll tell you, when we coming back to kind of refinancing, right? So again, maybe I'll just review briefly. So we took out a second mortgage. It was a HELOC. And then we consolidated that loan with our primary mortgage. And then that was our new, basically, note against the house. But one thing we did, my wife and I at least, is we just budgeted. Can we afford our mortgage if whatever real estate stuff falls apart?
Right.
And we could, right? So we weren't like going to lose our house, right, on account of the fact that the real estate investment didn't work out. We might have a little bit more debt, and we might have to pull a few more hundreds of dollars into our mortgage payment, but we weren't taking on some kind of risk that put our own personal livelihood at stake.
Right.
And
that's a misconception that, we hear that all the time. What happens if this doesn't work out, or whatever.
And that's the fear of the fear, right? You have to know, what does that worst case actually look like? Well, your investment didn't work out. Okay, well then what happens? Well, you go about your life. That's all that happens. Right.
And if you look at it, like the true failure rate, we talked about the venture capital, right? In the IT world, which is the world that I come from, 1 out of every 10 investment does well, right? So the venture capital funds, they're deploying, say, take AI, right? In the AI space, they're going to invest in 10 AI companies. They do their due diligence and they might have a good team and a great idea and all that, but they're going in, fully knowing that 9 out of those 10 are going to blow up,
Right.
going to vaporize, zero, right? Versus with real estate, even depending on the asset class, some market cycles will take out some people. Like right now, the higher interest rates is causing some distress, especially in the multifamily world, where you had some people that just said, "Hey, everybody's doing this. I could raise money, and anybody can do this," but they're not really focused on the details. But if you look at it really, you dive in, and this goes down to the details. What is the failure rate in self-storage? The distress rate, meaning that for every loan that's out there, what percentage of those are underwater or in trouble? It's less than 2%. Right? Less than 2%. So if you invested in 100 investments in self-storage, 2 might have some problems, right? That's if you like data and you like percentage, it's pretty good odds, right? Multifamily is over 10. Office is getting clobbered, right? But that goes back to COVID, and we're in a totally different era. So that's really what we're talking about. And then you factor in the leverage part, is really that you're investing next to a bank, and you know that like the bank's job is to, and you look at where you're at in the pecking order of leverage. So for example, you get paid, your money gets direct deposited into a bank, right? And what's that money earning historically, crap, like less than 0.5%, right?
Sure.
0.1%. You get a few pennies.
Right.
What does the bank do? The bank loans that money out to people buying houses. How many of those foreclose and whatever, again, depending on market cycles. So what are you able to do? So that if the bank is loaning out money at six, and now in this case, 7%, right? In our case, 7 or 8%. Now we're taking that 7 or 8%, which is very low cost relative to what the potential is of the property.
Sure.
And that's where the magic happens, because the goal for us is now to exceed 7% to pay that mortgage. For what we do, when you look at the revenues, that's not that difficult. For us, a bad investment is generating a 10% per year return.
So here, I'll put numbers to it. When we bought this property, we took out the loan against our house, right? The HELOC. I think we, in total, made a down payment. I want to say it was like around 110,000 in the building, right? It was a commercial loan, so we had to make a higher percentage than you might for like if you were a personal loan. So I think the building sale price was like 455, somewhere thereabout. So I think when we opted to kind of keep cash in the business for the time being, but I think when we were collecting distributions, it was about $1,200 a month. So, and the way we had it structured was we were putting in, I think, a third to the other partner's putting in 2/3. So for a third of 105,000, about 35-40,000 that we put into the building. 35-40,000 that we put into the building, plus, and you're getting $1,200 a month. There is no investment that can perform on those terms.
Right.
And it's all based on the principle of leverage, right? Because you're not buying $120,000 worth of cash stock. You're buying a $450,000 asset levered, right? And $450,000 of property can create, $1,200 of cash flow.
Yeah.
And so that's the lever. It's not risk, it's a lever, right? They're not the same thing.
Yeah. So take, for example, and I want to be mindful, we're just over an hour right now. If you guys have questions, please you can even raise your hand if you want to ask it out loud, and we can enable the mics on there. I appreciate everybody still sticking around. But the case study I want to mention is this building is going to cost $16 million to build.
Right.
Okay. 2.5 of that is to the land. So call it $14 million. Of that $14 million, 10 of it, the bank has given us at a 7.5%, between 7.5%, 8% interest rate. And oh, by the way, it's interest only for the first few years till we get it, started getting leased up. Our estimates right now, and they're conservative because, and they're conservative for a lot of different ways. We don't have the time to talk about it right now. That's not the point of this. But our conservative underwriting says that when this thing is done being built, strictly based on the revenues and the net income that it's going to generate, it's going to be worth $25-26 million. Okay. Now, that is the cost of building and whatever. And yes, there are risks associated with development and all of that, but we're building a bunch of boxes. So from that standpoint, we feel really good about, you got to build the structure, the riskiest part of that is the foundation and coming out of the ground. However, if you think about the banks giving us $10 million and the investors are putting in $14 million, we would have to be wrong to the tune of $10 million. $10 million, we'd have to be wrong,
right,
in order for that to not generate a positive return.
right.
Right. And so like when you think about what is the risk, what are we talking about? We're talking about, at the end of the day, you've still outperformed substantially everything else you can invest in.
I also think, and this is perhaps for your non-accredited audience, I don't know of many opportunities, right? And I'm also a non-accredited investor, that I have to invest in a $16 million asset,
Right.
Levered, right, as a non-accredited investor, and have some direct stake in, and particularly a self-storage facility. So if you decide, I don't like self-storage, fine, okay. But if you're interested in self-storage and you want to operate on scale, like the rest kind of, the other questions all resolve themselves at that point.
Yeah, yeah.
And I figure if either of those things wouldn't apply, you probably wouldn't be on the call, frankly.
Right.
But truthfully, like if you're non-accredited and you're trying, when would you ever have access to a $16 million product?
Yeah. Well, and
that is going to be managed by CubeSmart, which is one of the top REIT operators in the self-storage industry. So the project is triply validated, right? We do our own underwriting. The bank does their own due diligence, and that we get third-party feasibility study. And then the manager comes in and underwrites it, and they give us their pro forma. So we've got all these other these kind of external views and underwriting to really make sure that our projections are founded in fact, and everybody else's wealth of knowledge.
Kind of just to take this home, one of the dangers, I don't know if I would call it a danger, but one of the challenges that we've seen for new investors that come into real estate or passive investing is maybe you're good at analysis, maybe you're in some industry that requires analysis, get so laser focused on trying to analyze numbers that just fundamentally just get wrapped around the axle and then get paralyzed by it, you know? And that's like when we were looking at deals like you were talking about, it was the analysis on paper and a spreadsheet made sense, or, from your point of view. But when we break it down to the fundamentals, like what are we going to do? What are we building, and how do we make money on this thing? That's all like that's easy stuff. The location, right? What is the business plan? And this goes back to whether you're looking at self-storage or any other passive investing. Does it make sense? Does the story ring true? If you're looking at an apartment building where they're saying, okay, right now the rents are $1,000 a month, we're going to put in a new kitchen, and now it's going to be worth $1,500 a month. You ask yourself, okay, what does that entail? That entails I got to remove the tenant. Number two, I've got to go in and do it. And we've been through renovations. They're not trivial. There's a degree of risk there. So, and the business plan there, it says, okay, what is the worst case scenario? Maybe you can't get 1,500, maybe you can get 12, in which case then it still might pencil to be a solid deal. So really it comes down to just, does it make sense? Any questions coming in?
Yeah, some questions about, do we have any investments that are paying monthly? We do. It's for accredited investors only. So
we have our income fund, which is a debt fund. It's a different instrument. That's just high cash yield. That's the monthly. All of our other projects are distributions are quarterly, and the quarterly part of it is, as we were talking about earlier, is when they're levered, we've got debt covenants, and with storage, when they're fully stabilized and mature, then paying monthly may make sense when you're executing business plans and you're working towards quarterly is really where it makes sense. And quite honestly, as an investor, we never want an investor to be conditioned to where now they need that monthly income, right? With your property, you're not taking that money out, right?
And if I do, it's never because I need it.
Right. There's always the concept in investing. It just says, don't wait to invest in real estate. Invest in real estate and wait.
Sure.
Right.
Sure.
I mean, you look at your own home and just look at the appreciation, and everything. And I always say that the real world inflation, and we're not talking about now, we're not talking about the last few years, always double digits.
Right.
It's always double digits. If you don't have an investment portfolio, or your income combined with your investment portfolio is not growing by double digits every year, you are getting poorer, not richer. And that's the strain that we feel, whether it's, buying that piece of furniture or whatever, that's junk that lasts for a year, and then you got to buy it again, and everything is cheaper. I even look at a pair of shoes. You buy a pair of shoes, say you pay $150 of trash, right? And a year later, you're buying another 150 pair of shoes. Whereas if you bought the 300 pair of shoes from the get-go, you probably get another year out of them.
Right.
But anyway, so the point there is inflation is everywhere. It's creeping up. We just got to notice that YouTube TV is going up some stupid percentage, right? You have to think about your dollars that not only are you earning, that are accumulating from a 401k or this or that. It's got to go to work. You got to put it to work. And yourself, not just rely on your mutual fund or your matching and all of that. When I got into investing when I started to look at my 401k when I worked at the Federal Reserve. I'm like, man, this thing is growing pretty good. And when I started to dive into numbers, I said, it's growing because I keep putting more money into it. I was like, it's like, this thing is not, it's growing like 10% here, loses 4 here and there. And when you get these pops like we have in the stock market now, which by the way is not grounded in fundamentals, it's all smoke and mirrors. You got to lock in the gains and you got to redeploy it somewhere else. So anyway, any other questions? No, we've been going for a while. Thumbs up if this was worthwhile. We'll do more of this. Always just want to capture more of the stories, and our objective when Corinn and I started doing this, when we first went into 20th Street and started collecting checks, it was like, man, we need to share this. How do we scale it and how do we do it? The principles of real estate syndication that I've got up there on the fireplace, Corinn's dad gifted that to me, and that's kind of what started this. I started to read into it. I'm like, wait, holy cow. If we all put in money, we can buy a much bigger property. I'm like, that's pretty damn cool, And so now we've got a legal team behind us. We've got a construction team. We've got teams upon teams, and it's quite a ride and a journey.
In summary, I'm Corinn. This is Sergio. Sid, thank you for having this conversation with us and sharing a bit about our now
collective
15
journey.
Years of knowing one another and our lives together. Thank you all for being here with us today, and we will see you on the next one.